Have you ever noticed that the occasional weekend gap tends to revert towards the mean? Let's program a simple mean reversion strategy to exploit this phenomenon.
Weekend gaps are often caused by unforeseen geopolitical events. Military conflicts, political instability, and natural disasters often fall into this category. A memorable example would be the capture of Saddam Hussein in December 2003. Euro-dollar gapped down 150 pips when markets reopened on Monday. The drastic imbalance in supply and demand, combined with the thin liquidity over the weekend, create gaps when the market reopens in Asia on Monday. Eventually, with increased liquidity in the ensuing London and New York sessions, this imbalance tends to correct itself. In fact, I have observed that these weekend gaps usually reverse completely by the middle of the trading week. To find out whether these gaps can be exploited, a few observations aren't good enough. Let's test our gap reversal hypothesis by doing a long-term backtest on the 1-hour Euro-Yen. I'll whip out AlgoWizard and program a simple mean reversion strategy. Here are the entry conditions. It is Monday, and the weekend gap exceeds 3 times the 5-period average true range. Notice the weekly close has a time shift of 1 bar, meaning I'm referencing the most recently completed week. The daily open references the current day's open, so a shift of 0 is used. Trade management is equally simple. I'll set the previous week's close as the profit target, and a stop loss at 3 times the 5-period ATR. The decision to use ATR instead of pips for the entry and exit conditions should improve the strategy's adaptability. This will help it perform more consistently across various markets, or across different volatility regimes in the same market. Lastly, to limit market exposure, I'll exit the market on Friday at 2300 hours. The gap reversal, if successful, should have been completed by then. Since I'm only going to fade the weekend gap once, I'll set my maximum trades per day to 1. That's it for programming. This is an example of a successful trade. Here's the 2003 to 2021 backtest on the 1-hour Euro-Yen. That went much better than expected. The only bummer is the miserable sample of 48 trades. Of course, since sizable weekend gaps are uncommon, you shouldn't expect the strategy to trade much. To bump up the sample sizes, you can backtest the strategy on other markets too. Here's a few more successful 18-year backtests from the Aussie Yen, Dollar Yen, Aussie Dollar, and Kiwi Dollar. It does appear that Forex weekend gaps have a tendency to reverse by the end of the trading week. This statistical edge can easily be exploited, as long as you have strict risk management rules to protect your downside. Due to the low trading frequency, I don't recommend trading this strategy in isolation. You can instead include it as part of a diversified portfolio. If you want to learn how to create one, check out the video at the top right. Don't forget to subscribe, and stay tuned for more free trading tips.